You are listening to Small Business Straight Talk with your host, Amber De La Garza. Amber is a sought-after coach, trainer, speaker, and writer who gives small business owners the straight talk on productivity, time management, business systems, leading your teams, strategic decision-making, and mindset. No BS, fluff, or overused jargon. Just actionable strategies to get results and succeed in business. And here is your host, Amber De La Garza, the productivity specialist.
Welcome, and thank you for listening to the Small Business Straight Talk podcast. Today is episode 315, Tracking Operational Metrics to Skyrocket Profitability with Marcel Petitpas. If you're a small business owner who wants to learn effective business strategies, improve time management, and elevate productivity to maximize profits, reduce stress, and make time for what matters most, then you're in the right place, and I'm so glad you joined me. I'm really looking forward to bringing this episode so that you get to meet our guest, Marcel Petitpas. Marcel is the CEO and co-founder of Parakeeto, a company dedicated to helping agencies measure and improve their profitability by streamlining their operations and reporting systems. He's also the head strategic coach at SaaS Academy by Dan Martell, the #1 coaching program for B2B SaaS businesses in the world. In his work as a speaker, podcast host, and consultant, specializing in agency profitability optimization, he's helped hundreds of agencies around the world measure the right metrics and improve their operations and profitability without relying on financial data and accounting professionals, and take control of their business with simple numbers anyone can understand and measure. When he's not helping agencies make more money, he's probably watching The Office or Park and Rec on a never-ending loop and eating breakfast foods for every meal of the day. I have to tell you that I honestly believe that this may be one of the most valuable interviews I've done to date. And I don't say that lightly. I say it because the topic in which Marcel is going to talk to us about is a pain point that I know so many of you have. And I do not want you to get thrown off with the word agency. If your business is not an agency, this interview is still for you. I had him speak specifically to small business owners, and everything that he's doing for agencies can help you as well. I specifically asked him for examples with different types of businesses, showcasing what it is that they do, how they focus on specific data that you can control and track that actually front runs looking at your accounting numbers, such as your profit and loss. And when I say front run, what I mean is there are lead metrics and there are lag metrics. And your P&L is a lag metric. It's happened. It's in the past. Often a month, 2 months. Sometimes if you're not checking it all the time, it could be data from a year in the past. The data that he's sharing with us today are the metrics that you can tweak, turn the levers on, watch in real time to make an impact on your profitability. So I want to make sure that you're staying tuned. This may be an episode that you listen to a couple times. You are in for an incredible treat. Before we dive in, I do want to remind you that you have the opportunity to work with me. If you are thinking of hiring a business coach, now is the time to be talking. Don't wait. It's just a conversation, but it's a conversation with potential to get you on the quickest path to improving your time management and elevating your productivity so that you can better focus on growing a business that you enjoy. Whether one-on-one coaching or my group coaching program, head on over to amberdelagarza.com/call to schedule a discovery call today. And now, let's meet our guest and get to the straight talk. Welcome to the podcast, Marcel. How are you today?
I'm doing very well. Thank you for having me, Amber.
Yeah, I'm really looking forward to having this talk about something that many people might not find too exciting and sexy, but I do. And I think it's needed in our businesses. So let's just dive in. Can we first start off with why do I get to talk to you about measuring data? You're even wearing a hat. No one can see this. This is just audio, but your hat literally says data. So why do I get to talk to you about data in service-based businesses today?
Well, it's mostly because one of my first businesses was a service-based business. I think like a lot of entrepreneurs, that's, a thing that a lot of us find ourselves in a lot of times by accident. And I struggled with this stuff, these questions that I had to ask myself every day in order to run my business about, are we making money on our projects? And do we have enough work to keep the team busy? And who and when am I going to hire my next person? And that stuff kind of changing every day as deals come in and people issues come up. And really finding it difficult to find information on this that was consistent, that was easy to understand, and to get all the data together that I needed to make decisions based on something other than my gut. And so having experienced that in one of my businesses, when a friend of mine called me and said, he's running a much bigger software development agency than I had ever run. And he said, man, my team spends a day or two a week in spreadsheets trying to figure this stuff out. There's got to be a better way to do this. And it resonated right away because I had experienced that. And we just started talking to other service-based business owners, and every single one of them, once you broke through the armor a little bit, would generally have the same set of challenges, which was basically like, I look at my P&L every once in a while, I talk to my accountant, but to be honest, like I really don't know how or why the business is, profitable or not profitable. And that just makes this experience of running a business so much more stressful than it needs to be. And so we made it our mission to solve that.
Oh my goodness. That is 100% correct. And when you don't know why you're making decisions, because it's not like you can just run a business and just not make a decision about hiring or can I take this project on or not. So really you're winging it based on the information you have, which doesn't feel good. It doesn't feel confident. It doesn't feel like you're in the driver's seat of your business. You feel like, oh my gosh, did I make the right decision? And so data can really drive us in that way. So how did you unlock this? How did you turn a day and a half, all these spreadsheet and numbers into something that can be helpful for the everyday person? Like my understanding is when I research you, like this is for the everyday business owner. This isn't like you have to understand you don't have to have a financial degree. Like you didn't need to do that kind of education to get here.
Well, it took years, to be honest with you. And the first big thing that we had to crack was the framework itself, because this is the problem. And many people that are listening have probably had this experience. You start Googling this stuff. How to like, what is the gross margin of a service and how do you measure that? It seems like such an easy question, but then within that question, there's like a million little questions of, well, how exactly would you allocate somebody's payroll to a project or to delivery if they don't spend all of their time there? And what about overhead? How exactly do you determine the correct heuristic for figuring that out into your cost basis? And how do you calculate somebody's average cost per hour? What number of hours is that based on? Is it based on all of the hours that they have available in a year? Is it just the amount of time they're supposed to be doing client work? So it's actually really complicated to get down to a framework for exactly how to measure metrics, which metrics to measure, and how to do it in a way that they're consistent with one another. So when I push on one thing, I know the impact it's going to have on everything else. And that took us probably 2.5 years of iteration and research and testing and applying it to all kinds of different service-based businesses to finally land on something that now can work across any service model, any pricing model, any staffing model, and normalizes everything down into kind of a standard set of numbers. So that was the first big nut. But now that we've done that, it really does make this quite a bit simpler and quite a bit more accessible to somebody at whether they're just starting out in service or they're growing a really big team. And the other nice thing about it is it's simple to understand, which means you can start to create more accountability with the team, which is a challenge as you start to scale. It's not just about you having this information, but if you're hiring a suite of managers or you're putting a C-suite in place, they need to know if they're performing well or not too. So having something simple that they can get a grasp on is really key there as well.
Yeah. So well, I have so many questions. They're wanting to all come out at the same time. All right, talk to me about what do you find are the most important metrics to a small business owner, service-based, if they're just getting started with metrics, right? Like my mentality is never like go from nothing to like now you know everything and you're doing everything. There's got to be this gradual buildup. And so would you agree with that? And where would they start?
Yes, totally. And so I want to talk about two sets of metrics that I think are really important. The first are financial metrics. And I want to talk about those mostly because most people already have some kind of financial reporting happening in their business. So to me, it's like, okay, well, if you're already doing that and you're already spending time and money on that, let's get a little bit more value out of that exercise. So if nothing else, you have something that's useful when you get that P&L back from your accountant or from your virtual CFO or whatever you're using there. Now, I don't focus on financials exclusively because there are a lot of problems with financials and relying on them for insight. We'll talk about what those are. So the second thing I want to talk about today is 3 numbers that are more related to your operations that you can use to understand why your profit and loss statement looks the way that it does, to have more control over the direction that that profit and loss statement goes over time, and to be able to do that much more quickly and in much more timely fashion than having to wait to look into the rearview mirror at what has happened and have more control over the decisions you make on a day-to-day basis and really bridge the gap between the finance of the business and the actual day-to-day operation. So that's my objective, just to frame up kind of what I'm hoping to cover today.
Yes. So I'm assuming you're talking about lead and lag metrics and one that's serving you a bit, better than the other because you can actually impact it.
That's right.
You want to just go into that a little bit? I'm sure I think that's what you were referencing. So, and I don't know that everyone listening may understand that part.
Yeah. So to your point, there's leading indicators of success and there's lagging indicators of success. And unfortunately, most of us, especially when we first start out, one of the only ways that we really get a scorecard or feedback on our performance as a business is looking at our financial statements. So, our accountant sends us a report. Here's how much money came in. Here's how much money is spent. Here's how much money is left over. And we either drink to celebrate or we drink because we're sad. And then we kind of go back to trying to figure out what we're doing. So that's inherently retroactive. And finance has this unfair disadvantage in that it has to be very precise because there are tax and legal implications in finance data. And so it tends to be this thing where you have to wait until all the transactions are in. You then need to reconcile those. You got to go through the bookkeeping process. And so it's very rare that we're seeing that information within a week or two of the month being over. So it's 30, 40, 60 days late by the time we look at it. We're looking at 2 months ago, trying to make decisions for today. And so that's where it becomes really important, to your point, to have metrics that can tell us about the future and can give us a sense of what we're doing today and how that's going to actually impact our performance. Because if we're constantly making decisions today based on stuff that happened 2 months ago, it's going to be really, really challenging to address the things that really need to be addressed.
Yeah. All right. So which area do you want to start with first?
Let's start with financials because that's what most people are focused on. And then we'll bridge the gap to operations. So most of us get a P&L from our accounting team, hopefully on a monthly basis. Maybe for you, it's quarterly. And, hopefully you're not one of these people, but some people once a year, they just kind of find out how it went. And that's that. Regardless, most of us are investing there. So the mistakes that I see a lot of people make when they run a service-based business and they're getting a profit and loss statement from their accountant is that their profit and loss statement is structured for general accounting practice. And it assumes that they're selling basically products as opposed to services. And so the first big issue that I tend to see there is the thing that's called gross profit on their profit and loss statement is actually what we would call their agency gross income, which is the revenue that they bring in that belongs to them that needs to get earned with their time. And the reason that this tends to happen is because accountants will consider cost of goods sold to be all of the pass-through expenses that flow through the business, right? So for example, if you run a Facebook marketing agency and you have clients that pay you $10,000 a month, but you spend $5,000 of that money on Facebook ads, well, on your P&L, what that would look like is income is $10,000, cost of goods sold is $5,000, and then they would call gross profit $5,000. But actually that $5,000 that's left over, that's your revenue as a business. You still have to spend money on payroll and labor to earn the rest of that money. So that's the first big issue is we want to isolate our pass-through expenses and understand that our revenue minus those pass-through expenses is actually our agency gross income or the true revenue of the business. And that's what we want to be benchmarking our profitability based on. So that's kind of the first big idea.
Mm-hmm. Okay. Yeah. I'm Keep going. This is so good. And I don't even think you understand how much you're talking to the exact right audience. I mean, we're talking to architects, we're talking to interior designers, we're talking to builders, attorneys. Like this is like you literally just described their pain points of not understanding which numbers should they even start to be looking at is where you're starting with. So keep going.
Yeah. Okay. And so that's kind of the first key point. And I'm not saying that, just to be clear, I'm not saying it's problematic to structure a P&L that way. But what is problematic is inferring gross profit when it's calculated that way as actually being gross profit or gross margin, because that's clearly not what it is. And the reason that's problematic is because if you go see your accountant and your gross profit looks really good or it looks really bad, you're going to want to take an action based on that. That's probably not actually the right action to take. So the next thing that we need to be able to do in order to really understand what our true margin is as a business is we need to isolate what we call delivery costs. And delivery costs is what I would attribute to anything related to getting work done for clients. So most of that is going to be made up of payroll. And if you have a team of people, some of those people, 100% of their payroll will be allocated to delivery. So for example, again, if you ran a marketing agency, if you have a designer and their full-time job is doing work for clients, you probably allocate 100% of their salary to that. If you as the owner, you still do a little bit of that, maybe 25% of your time goes to doing client work, you would allocate 25% of your salary to that area. We don't want to do it based on timesheets. We want to do it based on this kind of ideal, realistic scenario of what your job actually is in a perfect world where you have unlimited work to do. How much of your time would be allocated to that area of the business? And then you're going to have usually 4 to 6% of your agency gross income in what we call shared delivery expenses. So those are going to be things like software licenses, tools, maybe libraries. So if you ran a design firm, this would be your Figma subscription, your Adobe Creative Cloud. If you ran a marketing firm, this might be some software you use to manage ads for your clients. It's not just for one client, but it's like a tool that your team needs to bring to the job every day. And of course, if you run like a home services business or an architecture firm, you might have actual tools that you bring to the job. So you want to allocate those to delivery as well. And that really is, if we're tying this back to general accounting terms, that's really your cost of goods sold. That's what it's costing you to get work done for clients and earn that revenue. And your margin, really as a business, your what should be called gross margin, but we're going to call it delivery margin so that accountants don't get mad at us, is going to be that first layer of revenue minus pass-through, which gets us to agency gross income. And then we're going to now base our margin on agency gross income minus all of these delivery costs that I've just talked about.
Okay.
So I could draw out the numbers to like give an example, but that's kind of the high level idea. Let's say you make $1.5 million. You spend $500,000 on ad spend. So you have $1 million in agency gross income. Let's say you have $400,000 in payroll and shared delivery expenses allocated to delivery. That means you have a $600,000 delivery profit, which would represent a 60% delivery margin as a business. So that's how you would think about that on your P&L. So the important thing here is to clearly isolate your pass-through expenses and then be able to clearly isolate your delivery expenses. And the reason most people aren't doing this is because all their payroll goes into one big account called payroll. All their software goes into one big account called software. And so they actually can't tell what their profitability is at kind of a gross margin level unless they start double clicking into those accounts and doing a bunch of manual math.
Okay, I have a couple questions. When you said payroll about a delivery cost and you said realistic, I 100% agree. An owner's probably doing 20 to 25% of working with clients. They're running the business the other time. But an employee is never 100% billable, right? There's team meetings, there's administrative. And so do they also have a percentage, or are you saying like they have to be paid their whole salary to get to keep the doors open, so it's an entire cost?
That is a great question, Amber. And you're leading now into the operations metrics. So we'll talk more about that. But yes, this is kind of the question that a project manager would typically ask me, because they tend to be very detail-oriented people. And so they're like, this person isn't 100% billable. But here's the thing is we want to see the cost of utilization in our gross margin. Because here's what I see a lot of people do. They fall into this precision trap of saying, instead of allocating people's salaries based on this kind of percentage, I'm going to do it based on timesheets. So at the end of the month, I'm going to go and look at how much time Amber actually spent on client work, and I'm going to allocate her salary based on the percentage of her time that went there. And that seems like it's going to be more accurate because it's more precise, but it's actually less accurate. Because if you think about it, the reason that your cost might go down in a month is because we didn't have as much work to do as a business. And generally,
I had to pay him.
I still had to pay you.
Yeah.
And usually I'm going to find things for you to do when we're not that busy. So you'll spend some time working on the company website. You might spend some time updating some SOPs, right? And now we're going to start pushing the cost of poor utilization into sales and marketing and into administration. And so it's really kind of giving us a false sense of what's really going on in the business. It's not that our costs are inflated there. It's that our utilization is low, and that should impact our delivery margin on the profit and loss statement. So that's why we would want to do these allocations in a more static way.
Yeah.
And it's based, again, on an ideal, realistic scenario. So if we had unlimited work to do, what percentage of somebody's time would be meant to be spent in this area of the business?
Okay. And I know you said that was a detailed question, but I have one more, and you can not answer it if you don't want. But to your point is that, an employee gets 2 weeks of vacation, they have sick days, and you still have to pay them generally their salary. They're getting paid for that. And so if you don't consider that part of the delivery, it gets really messy.
That's right. Yeah, you want to see those costs reflected there. And so that's why we would want to include it. And we'll talk about kind of how we balance that with our operational metrics when we talk about utilization and average billable rate. But these are the details that when you haven't thought all the way through them, you might choose one way to measure your delivery margin on the profit and loss statement, and then start thinking about how to measure, the project level delivery margin. And then those two things start to get calculated differently because of these idiosyncratic things. So I love that you're getting into the details. This is great. And hopefully the audience is going to benefit from that as well.
Absolutely. So I just want to give one message to the audience. Whether you're listening and your team is billable in some of the industries that I shared, like interior design, architect, your drafter is going to be billable per hour. If you're an attorney, your associates are billable per hour. But everything he's saying is still just as relevant if your team members are not billable to the client and not billable per hour. So keep listening, stay with us. I know I have an idea of where he's going. This is really good. It's relevant to you as well.
Yes, absolutely. And so let's talk about what we do with those people that are not billable, just to make sure that it's clear. So once we understand what our kind of delivery margin and delivery profit is, the next thing we need to do is we have to run the business. That's where overhead comes in. So generally, we encourage clients to make sure that they can identify how much is being spent across three broad areas of the business. The first is sales and marketing. The second is administration. And the third is facilities. And in total, those things should end up being 30% roughly of their agency gross income. And that will include payroll allocations, and it will also include hard costs. So as an example, if you have a person on the team, they spend about 50% of their time doing delivery work for clients, and then the other 50% of the time, they're actually helping bring in new business for the company. Then you would split their payroll 50% to delivery and 50% to sales and marketing. And that would give you an accurate representation of how much you're actually investing in those areas of the business. And again, we want to do that based on kind of what is their role designed to be. So that's how we want to think about the whole P&L. And the objective here is that we spend about 30% on our overhead, which means we need to have enough gross margin or delivery margin in the business to achieve our net profit target. So if I want to have a 20% net profit at the end of the year, and I know I'm going to spend 30% on overhead, that means I've got to get my delivery margin to at least 50% on the P&L or higher. Because if I don't do that, where's that money going to come from? Well, it's going to come from the bottom line. So that's how we kind of want to work from our net profit target back up through our targets into the P&L. And again, by really actually identifying what is our delivery margin, we can start to differentiate between, is my problem related to profitability because we're not fundamentally profitable at doing the work that we do? We have a utilization problem. We spend too much time on projects. We're underpricing them, right? That's a very different problem than we spend too much on overhead. But when the P&L is structured in the traditional way, all of the delivery costs and overhead costs are in one big bucket. So we frame everything as overhead, and most of the time, 9 out of 10 times, the problem is actually a delivery margin problem. And that's where all the leverage is. So that's why I'm really big on trying to create that separation so we can get a sense of what those two numbers are independently.
And you have an average of 30% for the overhead.
Yeah.
I want to make sure you're using a lot of new, different kind of words for the different scenarios that I know. So I want to make sure I get it correct. Correct me if I'm wrong. So 30%. And do you have an average target for the delivery line items?
Yeah, we typically want to see that be between 50 and 60% margin. So what that means is for every dollar that you collect from your client after you strip out pass-through expenses, you want to spend no more than 40 cents on delivery expenses to earn that money. So if you have $1 million in income, you probably want to spend $400,000, maybe $500,000 on delivery costs. And when you model out, how much revenue can we earn with our team, you want to make sure that that kind of a margin is possible. Because if it's not to say that you can't be profitable, but you're going to have to be more efficient than average in other areas of the business to make it work.
Yeah. May I ask where you got these targets from? These targets are numbers that client after client, business owner after business owner I speak to are asking, but they're asking in a different way. They're saying, in my industry, what should these profit margins be? And I didn't hear you say that. So how did you get these target numbers?
Yeah, these numbers are from 5 years of doing audits on professional services businesses. And we do anywhere from 3 to 6 of these a month. So you can do the math on how many businesses we've seen. And then we've also been involved in some industry benchmarking exercises where we collected data from hundreds and thousands of firms. So that's where we're getting these values from. And it's unbelievable how consistent these ratios actually end up being, even across industries. So we spend a lot of time with marketing agencies and creative agencies, but we've done this in other professional services verticals, including consulting. And these ratios pretty much always end up back here once we normalize for the things that are idiosyncratic, like pass-through expenses.
Excellent. All right. Now, my understanding is you had these 3 buckets under the overhead expenses. Does if we're looking at the P&L, that means every expense goes into one of these 3 buckets. So there's nothing else we need to consider before we're getting to the profit at the bottom.
Yeah, there will be things like other income and other expenses. You'll have, depreciation and things of that nature. So there might still be some things that fall outside of the norms. Let's say you're making interest on investments or you have exchange rate win or loss, right? But outside of those things, the operating expenses of the business should fall cleanly into one of those things. And some of them you might need to do splits for. So I don't know, you take a software like Google Admin Space where is that administration? Is that delivery? Is that sales and marketing? We kind of use it for all of those. So you might have to make some splits or you might have to make some kind of rough allocations, but you want to get a directional sense of what percentage of your income is being spent in those different areas so you know if the business is in balance or not.
Yeah. So I'm just going to speak to, so I do my own bookkeeping. My business is incredibly simple. I always like to give that disclosure. It's pretty darn simple. But one thing that I do that I don't think is common is that I don't do my P&L just as if they were for my taxes, right? So I actually have very similar categories and then subcategories so that I can quickly see what is my sales and marketing, and then under it, what every strategy. And even my contractors, if they're working part on podcasts and they're working part on something else, that gets split up into each of the strategies so that I can see it. Now, it's as easy as a roll-up when my taxes have to be done. But for me, my P&L should be serving me to make decisions. And I know that, if you're hiring someone to do this for you, that's not what they're willing to do. They're like, here's the categories, here's how it actually gets pushed through for taxes, and that's about it. So it sounds like they're going to get much better data that's analyzed.
That's the idea, right? You're already making this investment. So sit down with your bookkeeper or accountant, show them this podcast episode, and work with them to say, hey, how can I get a little bit more insight into these things since we're already going through this exercise of doing the bookkeeping every quarter or every month? And this is a perfect segue into talking about operational data because you've just highlighted one of the several problems with relying exclusively on finance data for insight. We've already talked about the fact that it's retroactive and we're looking backwards. The second big piece that you just touched on here is there is this tension, a very direct tension between tax efficiency and reality a lot of the time, right? The things that your accountant's going to tell you to do in your books to decrease your taxable income is often going to obfuscate how profitable the business actually is. You put some personal expenses in there that are kind of in the gray area. You might push some invoices off into next year. You might pull some expenses back into this year and prepay for some things next year. You might do some funky things like that. And all of a sudden it looks like the business isn't that profitable. And so if you don't have this differentiation between the books that you use for taxes and then this kind of more realistic look at the business, then you're not even really getting an accurate lens on the business. And then the other two challenges is you have cash versus accrual accounting. And if you run a smaller business, you probably haven't made the investment to go to accrual accounting. And so it's very possible that just inherently your cash books are not at all reflective of how you earn revenue in your business. For example, if you did websites and you were working on a $100,000 website and you got a 50% deposit on month one, and then you got the rest of it when the project was done 4 months later, well, then the first month is going to look incredibly profitable because you got paid 50 grand and you spent almost no money. The next 2 months are going to look terrible because you collected no money and spent a bunch. And then the last month is going to look incredibly profitable because you got paid a bunch of money and then spent a little. And so cash books become really difficult to get valuable insight from unless you're zooming out to very big time horizons where you can normalize all of that stuff. And so that's another big challenge. And then lastly, if you're small and early, your P&L is just not going to be that reflective of reality because you might not be paying yourself that much or that consistently as an owner. You might be subsidizing different areas of your business by doing that work instead of paying other people to do it. And so finances are, of course, the thing that we're all looking at, but they're not going to give us a really good set of insight, especially if we're early on in the business. So that's where I think it's really important to then look at what are some simple numbers we can look at on the day-to-day that will help us get a sense of if we're on track or not.
Yeah, let's dig in.
Okay, so there are 3 numbers I want to talk about. And these are the numbers that will improve the delivery margin of your business. And that to me is the lifeblood of a service-based business. If you have strong delivery margin, which means you can get paid $1 by a client and it costs you very little to earn that dollar. And when I say you've earned the dollar, I mean the promise that you made in exchange for that dollar has been delivered. So you got paid, the work is now done. How much of that dollar is left over, right? So if you think about that in very simple terms, the more of that dollar is left over, the easier it is to pay for all the overhead expenses and still have something left over as a profit at the end. So if we can fix that problem, if we can make that really healthy, everything else gets easier. And to a large extent, making investments in the business and deciding if you want to maybe spend a lot more money on sales and marketing to grow faster, or maybe you want to pull more cash out and, buy a new boat or whatever it is you want to do with that, that becomes a choice. And now the business is happening for you as opposed to you. So that's a big idea is if we focus on gross margin, it kind of changes the context of the business. So there's 3 numbers we can use to do that. The first is related to the cost side of the equation. So we know that our formula for delivery margin is our income minus our delivery expenses divided by our income. So $1 million minus 400,000 divided by $1 million is 60%. So there's 2 ways to improve that number. We can either lower our costs without lowering our income, or we can increase our income without lowering our costs. Thanks, Dr. Marcel. That's you don't need a PhD to understand that. But how do you actually do it, right? So the first operational metric that we want to pay attention to is average cost per hour. And what this helps us measure is for any area of the business, on average, what did it cost us to spend an hour doing that work? So if you think about this, you can measure this for a client, for a project, for a whole department within your business. And you could look at this for a day, a week, a month, a quarter, any time period. And all you need to calculate that is what did you spend on payroll? Or what did you spend on payroll and what was the capacity for that given payroll? So if you paid somebody $100,000 in salary and they had 2,080 hours of capacity in a year, then their average cost per hour was $48. So using this metric, we can start to get an insight into, what kind of work do we do where the average cost per hour is much higher? What kind of work do we do where the average cost per hour is much lower? And the way that we can think about lowering our average cost per hour is essentially by trying to get lower context or lower judgment, lower experienced people doing more of the tasks on a given type of work, which over time should lower the payroll that we need to earn a certain amount of revenue. So to give you a practical example, when I first started my business, I would do all of the work on our audit product, about 40 hours worth of work. And then we started documenting our SOPs. We started, creating better processes. We started building some technology to automate things. And we were able to get an account manager that makes about half as much money as I do to do about 75% of the work, collecting stuff from clients, setting up the spreadsheets, setting up the template for the deck, all the back and forth. And so by doing that, we were able to lower the average cost per hour for that kind of work pretty substantially. And now as we scale the team, rather than having to hire a bunch of really expensive people, we can hire more inexpensive people and still grow the number of clients that we can serve. So that's kind of a practical lens on how do we lower average cost per hour.
Okay, excellent.
So that one is my least favorite. That's why I start with it.
Okay.
Right?
I do actually have a question. And I can't wait to get to your program. I actually don't know a lot about the service you offer. And before we even hit record, I was like, yeah, just give them give them advice, which is I tell every listener. But now I'm like biting at the bit for myself and my clients to hear because this is like legit what they need to do. I can't believe I said legit. Okay, this is really what they need to do in their businesses. And yet, like, they're like, but I'm not the numbers person. Like, he just literally gave this formula of like, take this, divide this. I'm rapidly taking notes. I'm like, yes, I get that. But I'm assuming this becomes a lot easier if they're using some sort of program. So I'm jumping the gun here. That wasn't even my question. Here's my question. The 100K, does your program say actually the real cost isn't that he or she gets 100K, but there's taxes, there's payroll expenses, yes. Like it's the actual real amount. And I just want to highlight that because I have that conversation a lot. Oh yeah, I pay so-and-so 60,000. I was like, yeah, they're not costing you 60,000. They're costing you far more. Here's a calculator. Go figure out the real cost. Let's start there. Yeah.
That's right. Yeah. So that's exactly right. When you're thinking about average cost per hour and calculating that number, you want to do it based on the fully loaded cost of employing that person. So that's going to include benefits. It's going to include payroll taxes. It's going to include if you do 401k matching, et cetera. And there's also some gray area stuff. So like if you buy them a new laptop every 2 years, you probably want to factor that in. So like what is the cost of employing this person fully loaded? Now, the flip side of this that I also get quizzed on a lot is, typically when we calculate average cost per hour, we do it based on what we call gross capacity. So for the average person, this is 2,080 hours per year. It's 40 hours a week for 52 weeks a year. And the question we get is the same one you asked with delivery margin, right? Which is like, but hey, they're not actually working all of those 2,080 hours. They get vacation, they get time off, they get billable time. Yes, I understand that. We are going to factor those costs in. In fact, we've already factored them into our delivery margin target, if you recall, right? Yep. So that's where the links between this come. And it's not about precision, it's about accuracy. And so when we're designing a system for how to measure all these things, we want to place complexity in the appropriate place. And so the cost of saying we're going to actually do average cost per hour here based on this adjusted capacity, and what's really dangerous is saying we're going to do it even based on utilization, is now there's all of these additional data points that are constantly changing all the time that make this number horizontally inconsistent. So what is the implication of that? Well, if I want to compare how profitable a project was 6 months ago to a project today, but it looks different because utilization was different in that month, well, now I can't actually see what was more profitable. It's not a horizontally consistent value. And so we need to isolate that. We want to consider the cost, but we want to do it in the right place. And then the added benefit is this is way simpler to calculate. I don't have to figure out how much time off they get and utilization and track down a million different things. It's real simple. 52 weeks, 40 hours, how much do they get paid, add all the benefits, there's my number. And as long as I set a target that compensates for everything else, I'm good.
All right, excellent. What's the next number that you like more than this one?
Yes. So this first one was related to decreasing costs. The next two I'm going to talk about are about how to increase the revenue earning efficiency of the team without increasing your costs. So how do you get your team to make more money with what you're already spending on them? There's two levers that we can pull to do that. The first is what we call average billable rate. And you mentioned this before. There's some people that are listening that are like, I don't bill by the hour. So they just checked out of the podcast. But I need to reel you back in because this is the thing I love so much about this metric is it works for every billing model and it allows you to compare any billing model to any other billing model. The formula for average billable rate is how much agency gross income did you collect? So again, that's revenue with pass-through stripped out. And how many delivery hours did you spend to get that work done? Now, I don't call it a billable hour. Notice the language. I don't care if the client was billed for the hour. I care how much time it took to get the work done. If you billed them for 100, but it took you 150, We need to divide what they paid you by 150 because that's truly how much money you earned per hour on average on that section of work. So
yes.
that's the metric.
Yes. And I'd like this number. I just want you to like highlight this, like whether you're charging hourly or not, you should know this so that you can know if it wasn't 100 hours. Next time you have another client and a proposal, like this is the data to say you need actually 150. Yes. Okay.
That's exactly right. Yep. And what's beautiful about this number is unlike, project-based accounting, you can, as long as you know and you can isolate how much did we get paid and how much time did we spend, you can again look at anything vertically or horizontally. You can look at a project, a client, a group of clients, a service line, a department, any cross-section, and you can look at it for a day, a week, a month, a quarter. So any area of the business, you can start to slice and compare, and you start to get really interesting insights when you do this of like, oh, that's interesting. Like when we sell website projects, we make $200 on average for every hour that we spend. And when we do SEO work, on average, we make $115 an hour. Well, that's interesting. Like, let's talk about that. Why is that? Should we change our pricing on SEO? Is there something really inefficient about how we do that? Is there something really efficient about websites that we could learn and apply to how we do SEO? Like, when you start to see this insight, you start to ask better questions. And this sounds like it's too simple to be true, but if you think about it, as a service-based business, by definition, your capacity is constrained by how much time you have across you and your team. If you could sell every hour that you had available for twice as much money, you would make twice as much money. It really is that simple. It's not easy, but it's simple. So this is the power of average billable rate, is it can start to show you the opportunities and the leaks in the business so you can be much more focused about addressing those.
Yeah. So the visual I give my clients is that because service-based business owners don't quite understand that no matter what they're selling, what industry they're in, they're selling time. And so I tell them that their business is like if you went into a grocery store and you set each hour of time on the shelf like a can, that is the maximum. And you add up all the hours for the people on the team, like that's the max amount of things that are available to sell. And your job is to sell each can on the shelf. And then it goes to everything that you're saying is like, do they know how many cans are on the shelf? Do they know if they're hitting like, I didn't sell 20% of the cans. By the way, cans are time, hours. That they need that visual because time is so abstract. And people have a difficulty connecting that dot from time to I sell the time to this black and white report, as we spoke of before, that means nothing to them called a P&L, right? Or little to nothing. They can't translate that. Okay.
100%. And so I want to double click on this metric because the misconception that a lot of people have is the way you increase average billable rate is you charge more. And that is one way to do it. You could charge more money for the same thing. And for most people, that's an opportunity. But I'm also not going to be one of those gurus that comes on here and says, you can charge whatever you want. Your mindset's the only thing blocking you from doing that. Like at some point, the pizza shop down the road has a limited budget for what they can pay you for the service. So assuming that we can get up to that upper echelon of what we can charge, the other lever is efficiency. Because again, the formula is how much we got paid and how much time it took us to do it. So if we can spend less time doing the same work, that means that our team can do more of that work. We increase the efficiency. And so again, similar story, if you can take something that used to take you 100 hours to do and you can figure out how to do it in 50, well, now you can do twice as many of those projects without changing your team composition. So those are the two things to pay attention to for increasing average billable rate is, yes, look at increasing price, but also pay attention to how much time it's taking you to do things. And if you're constantly going over budget, that's going to lower that average billable rate and it has a real cost.
Okay. And so how do they find out that they're inefficient or that there's ability to be more efficient? We'll go on the positive.
Yeah, it's a great question. And typically that conversation is best had with the team. This is where I really believe in closing the loop. So the first step is identify what is and what isn't efficient. So if you run this report and let's say we do average billable rate by project, and you'll notice, hey, these are some projects where we thought it was going to take us 100 hours. We got it done in 70. Our average billable rate was really, really high. The client is thrilled. Double click on that. What happened? Why did it go so well? Is there something that we're doing here that we're not doing in other service offerings? Like, what can we learn from this to apply to the rest of our work? And then similarly, you'll see areas where, hey, we thought this was going to take us 100 hours, but it took us 150. Our average billable rate is way lower than we thought. The client doesn't seem that happy. What's going on here? And it's by having those conversations that you'll start to identify, hopefully from the team surfacing, hey, these are some things that feel clunky, or, there's a lot of back and forth at this stage, or we tend to make a lot of mistakes when we hand off from this department to this department. And it's those conversations that will highlight the opportunities to get more efficient and create buy-in simultaneously, which is also a very important part of actually having follow through on those ideas.
Yeah, this just goes back to what you said. The data allows you to ask better questions. If you go to a team meeting and you're like, hey team, how can we be more efficient? And it's dead silence, right? But so one example is my clients that are interior designers, right? They have a project that runs 12 months, 2 years, right? It's a very long project. And each project goes through a specific phase. And the number that I want them to get to is like, okay, well, how many hours are they spending on each phase? Because they generally either a flat rate or it's hourly. But they're like, oh, we could be more efficient. And I was like, wouldn't it be more helpful to understand which phase your team is inefficient? Like if you were able to take 8 phases and narrow it down to 2, then you can ask yourself, oh, is it a training issue? Is it a tech issue when it gets to this phase? Is it a communication issue because it runs off the rails with client communication? When you're taking something as large as a 12-month to 2-year project, you have to be able to narrow down where are we asking that question of where's the inefficiencies.
Absolutely. And the same is true for different types of clients. The same is true for different types of service offerings, right? The more you can get focused on the things that are the highest leverage opportunities, the more likely it is that you're actually going to get results. Because that's the compromise, isn't it, with business, is you kind of learn to accept that everything's always broken. The question is about prioritizing which things to focus on, because the idea that we can fix everything all the time, I think we know is not the reality. And so this helps us be objective about those things. And also not focus on the things that are screaming the loudest or that the most dominant person in the room thinks is most important. This gets us all on the same side of the table saying, objectively, this is the thing we need to do.
Yeah. All right. This was great information, but how does somebody start with these numbers? I know one advice you gave was, hey, listen to this podcast, go to your bookkeeper, CPA. You want some additional data on the P&L. But where does someone start tracking the numbers that end up making these results or this data?
It's a great question. Before I answer it, there's some people listening that if they're anything like me, I haven't told you about the third metric. I know we're getting short on time, but if I don't check that box, they will have an aneurysm.
No, I would.
And I would too.
Listen to this.
Right.
I would be calling you like, we got to do this again. Okay, please go.
So the 3 levers are: 1, average cost per hour. That's about lowering costs. The second is average billable rate. That's about increasing how much money we make for every hour that we spend doing work. The last one is utilization, which we touched on earlier. And to bring it back to the analogy that you shared earlier is, yes, we have a grocery store. We have cans on the shelf. You know what the scariest part about our business model is? Every day those things go bad. They expire and we have to throw them in the trash if we don't sell them. Think about that for a second. And so the question of how many of those hours were you able to actually monetize for the average billable that we talked about earlier is critically important, right? And it's kind of intuitive. We don't want to have a bunch of staff that we're paying, but we're not actually bringing in enough work for them to be productive on. And so utilization becomes really, really critical. And the way we want to measure that, again, really simple. We take the number of delivery hours in a given time period and we divide it by the total capacity, the gross capacity. And again, we do that because we want to see the cost of time off, vacation time, sick time, et cetera, reflected in that utilization. And we want to include everybody in that, including the people that don't do any work for clients, because again, we need to see their cost reflected there. So we can measure that for a person, for a day, for a week, for a month, for a team, for the whole agency, it doesn't matter. And those are the 3 levers that really have an impact on delivery margin. And just to illustrate this very quickly, because this all sounds really abstract. If I have a team of 5 people and they have, let's say, 10,000 hours of capacity, if I utilize them at 50%, that means they spend 5,000 hours earning money. Mm-hmm. If on average we earn $100 per hour, that team can make $500,000 in agency gross income. If we increase utilization to 60%, we now have 6,000 hours that we've sold. At $100 an hour, that's $600,000. And so that's a pretty big improvement. And last but not least, if we maintain that 60% utilization rate and we get our average billable rate from $100 to $125 per hour, we can now make $750,000 with that same team. So if we assume that their delivery costs were 300 grand and we spent 150 grand on overhead, in the first scenario, we had a 40% delivery margin and a 10% net profit, $50,000 left over on a $500,000 business. In the second example, we had a 50% delivery margin and we had a 25% net profit, 150K in profit on 600 grand. And in the last scenario, we had a 60% delivery margin and a 40% net profit, right?
Yeah.
And so that's the impact that what seems like a small tweak, 10% utilization, $25 ABR, look at the compounding effect that this has on margin. So I wanted to articulate that just to close the loop before I kind of point everyone to some free resources that they can use to start doing this on their own.
No, thank you so much. I really, literally probably would have asked you for a second interview once I realized I left that one on the table. All right. Thanks for keeping me on track. Let's jump into what are some resources. So how can someone take a next step on this information they're getting on this conversation?
Right. Well, I've put together some free resources because I want the person that was in the seat that I was in when I ran my first service business to be able to do this for free and get the information that they need to start without paying for anything or hiring anyone. And so if you go to parakeeto.com/toolkit, you can get access to a module that has training videos, that has templates, that has cheat sheets that'll help you start to measure these things on your own and really get an understanding of how this works within your business. So I encourage everyone to go grab that. And it's really there to serve the industry and try to make this easier for everyone. And
Thank you.
If you've gathered anything from the episode today, you'll have noticed a common theme. Almost every formula I've talked about requires you to understand how much time is being spent doing client work. So if you're not tracking that yet, please start doing it. It's not so that you can build a client. It's the most important piece of information that you can use to make sure your business is healthy and your team is not being taken advantage of.
Do you have a preferred app to track time?
I don't want to say I don't like this question, but yes, my preferred app for tracking time is the one your team actually uses. I think a lot of people get too caught up in this. We use Harvest. Lots of other people use Toggle. There's a ton of really good ones out there, but the most important thing is that your team actually uses it. And remember, accuracy is way more important than precision. Don't try to get them to track everything all the time, down to the subtask within the task, within the milestone, within the deliverable, it's too much.
You're
Just
echoing
start
everything
simple.
they've heard here for years. I love that answer. That's a great answer. Okay. All right. How do they find out more from you? Share with us your services, how they could find out about working with you and your company and your podcast.
Yeah, great. So if you want to learn more about Parakeeto and what we do, for sure, check out the toolkit and head to parakeeto.com. There's more information about us, and we publish lots of free content on these subjects. We also have a podcast. If you're a podcast person, it's called the Agency Profit Podcast, and you can find it wherever you're listening to this. And if you want to connect with me directly, head to LinkedIn. That's probably the best place to do it. I publish lots of content there, and I can't help myself but answer questions in my DMs. So reach out if there's anything that caught your attention today that you want to get clarified.
Absolutely. Thank you so much for being here. This was an excellent conversation that was 100% needed for many people. And thanks for being so generous with the knowledge and walking us through real examples. That was very valuable. Thanks for being here.
Thank you, Amber.
I have loved having you listen to the Small Business Straight Talk podcast. And I sure hope you found my conversation today to be incredibly valuable, insightful, and honestly making you think about how valuable your time is and how it gets invested by both you and your team, and how that's a direct line to profitability. No change. Without taking action, nothing will change for you or your business. So maybe you've told yourself, yes, I know I need to track my time. I will someday, maybe in the future. Today was your sign to go track your time. And look, I've heard it all before. You may even be having your team members track their time, but not you, the business owner, because you're switching back and forth and have so many things to be doing that it's just so challenging to track your time. The fundamentals of improving your time management and productivity is to understand where your time is going. tracking your time is essential. It doesn't even need to be perfect. You just need to get started so that you can better understand where you're investing your time, how it is ultimately impacting your business, both good and bad, so that we know where to double down on and where to stop investing your time. That is all data that in real time you can make decisions to help you improve profitability. If that is something that interests you, to get help in tracking your time and having the accountability and looking at that time and uncovering what business decisions can be made, what decisions need to be made with your time to actually impact the business, that is actually exactly what I do in my private one-on-one peak performance business coaching. If you're looking to take that data and analyze it and have it into a way in which you are getting those metrics and reports all of the time, I think Marcel's company is incredible. But if you want to start with just tracking your time and understanding how that has a real everyday impact, then just start tracking your time. It doesn't need to be complicated. It doesn't need to be fancy. You really can start anywhere. All right, I'll get off my soapbox. This is actually why I thought this interview was incredibly valuable. I would love the opportunity to work with you. I would love the opportunity to partner with you to look at where is the time being spent by both you and your team? Where can you be focusing your time to have the biggest impact? And look, none of this is just about, oh, I know I need to be focusing over here. Most often, we know that we need to be focusing on this or that. The work in my coaching comes from, how do you actually make that possible? What in your business needs to be fixed, or what decisions need to be made differently so that it is possible for you to invest more time into the things you already know will move the needle in your business. And the reason that you're not showing up in those areas of your business are not generally because you don't know where to be investing. It's because there's a lot of other challenges that need to be solved in the business so that you have enough time to show up in those areas. If you are currently finding yourself challenged in taking your business to the next level, I want to invite you to take my Next Level Business Owner quiz. In 3 minutes, you will find out what is most challenging you from taking your business to the next level, and you'll receive a personalized playlist from the podcast that solves those exact pain points. Head on over to amberdelagarza.com/quiz to take the quiz. If you are new here, be sure you hit subscribe so you don't miss another episode. I am so happy that you found us. And if you've been around for a while, I would just ask that you share this episode with another business owner who you think would find it valuable. So that's my straight talk for today. Until next time, have a productive week.